Thank you. I'm really excited to be talking to a group of people that are really keen on value investing. Normally I have to convince people that value is a good thing. So this is very exciting to me, and it's also the second time I've done this. So I chose not to look at my first presentation, and I'll look at it afterwards to see how much things have potentially changed and evolved in terms of how I explain what we do. What we do really hasn't changed, but sometimes the way you word it or pronounce it changes a bit. But it's a great honor, obviously, to be here, to be one of the few women that gets invited to be here, and also to be invited twice. So thank you very much. I very much appreciate the opportunity to talk about what we're going to do. Now I'm going to try and cover a lot of waterfront, and I'm very aware that you are students, so I'm going to cover some basic territory, and I'll keep moving on, and I'll be very cognizant the whole time that you are students and learning, and that you're keen on what really goes on in the real world. So I'm going to try and make it fairly practical overall. So I'm going to talk a bit about why value. And then I'll talk about some of the practical tools that a value manager uses, in particular our firm. Then I'm going to talk about something that I have a passion for. Value managers tend not to want to make forecasts. And that makes a lot of sense because we don't believe that economics explains what's going on. So I'm not going to forecast from a top-down economic perspective, but I'm a student of financial market history. And so I want to look at what's happened in the past, in the fullness of time, that we can look at what's gone on and use that to help point to what might happen in the future. It doesn't drive a lot of what we do, but part of what you do as a fund manager is to talk and communicate and inspire clients. And they often are very curious, where are we in the market? What's likely to happen next? Where should we be positioned? And it gives you that opportunity to give them some sort of commentary overall. I'm going to also give you 500-year-old investment advice from what I call the oldest value manager of all time. I'm going to comment about women in the industry, which I think is a very important topic to address, particularly in these times. We have a research competition. I'm standing in front of students, so I want to inspire more people to apply to our research competition. And then I will put up a chart on career advice. I've given that speech many times, mostly to women. And I'll just put it up, and then in the question period, if you're interested, I'd like to address what I call the 3 stages of a career. And obviously, it's very mindful of being in the investment management field and how to think and roll out your career in the investment management field overall. So let's get started with something that's really important about investing, which is, we call the behavioral psychology of finance. And it's been a hotter new topic in the last decade, and it's a fun topic to cover. But one of the ways of expressing behavioral psychology of finance is cartoons. So we'll start there, but I think it does a great job of picking up human emotions. You probably saw this cartoon. I first saw it in the early 80s. It was on the cover of The Economist magazine in the last decade, and I still think it's so relevant today. And what it is you've got, they call it just a normal day in the nation's most important financial institution. And I would say Bay Street, because we're going to talk about Canada in particular. And at the very top, you've got a guy on the phone, and he's saying, I got a really good idea here that could excel. And on Bay Street and Wall Street, if you're on the trading floors, they're very open. There's lots of people on the phone. They're all talking away. And people are very curious, what are other people doing? Because we're herding social animals. And we very rarely like to be contrarian and do our own thing. We're drawn to doing what the crowd is doing. So of course somebody's listening in, but of course there's a broken telephone, so eventually they hear sell. And then if other people are selling, maybe I should be selling, and so then you get this rip-snorting sell or bear market. And then eventually a guy, at the bottom end there, he goes, this is madness, I can't take it anymore. He throws his hat on his head and he says, goodbye. And of course, somebody's listening to that, broken telephone. Next thing you know, they're in a buying mania. And that's not too far off the truth. And I think that the market reflects human nature as much as it does underlying fundamental value. And that you can use that as a value manager to your advantage. And obviously you could tell I don't believe in the capital asset pricing model, that I don't believe that the markets are efficient and that you could take advantage of the inefficiencies that are present in the market to make good returns for investors. And then here's a guy, he's not invested in the stock market, he's on a precipice, he sees this train going by, it's full of people, they're all in the stock market, and so, being a social herding animal, he says, should I be on that train? And then meanwhile, the people on the train looking out say, look, that guy, the lonely guy in the precipice, that hedge fund manager there, what does he know that I don't know? Maybe I should be doing what he's doing. And so, again, just reiterating that we tend to want to do what the crowd is doing, and I think it leads to markets going to euphoric highs and depressed lows from time to time, well above and well below long-term true net worth or value, the value level, and creating opportunities for astute, disciplined managers to take advantage of the market and buy cheaply. I stole this chart from Jeremy Grantham. In fact, I spoke at a conference and at the CFA forecast dinner in Calgary, and I spoke before he did, and I stole a little bit of his thunder, but he was complimented, obviously. But he put together this chart, and he's showing the Fed model. And what he's showing here is he's showing like the underlying fundamentals of a market is the overall economic growth of the economy, which is the GDP. And he highlights in the box that GDP, 2/3 of the time only goes up 1 or 2 points. They're not that volatile. And same with fair value. Fair value is basically the Fed model. And it too is quite stable. And 2/3 of the time, it just goes up or down 1 or 2%. But then you look at the market itself, and it's much more volatile than the underlying fundamentals. And we would argue that that's the human sentiment, the human excess, the behavioral psychology of finance, where we get overly enthusiastic about stocks collectively and take it to euphoric highs, and overly depressed from time to time, creating, again, these opportunities. So just trying to underscore how frequently the market is mispriced and that you as a value rational manager can take advantage of it. It's not very correlated to earnings. A lot of people sort of assume that if you knew what earnings were, you would know what's happening in the stock market. And you can see there's some correlation, but it's not enormous overall. And same with interest rates, that there is some correlation, and when interest rates are at peaks or valleys, there seems to be some correlation, but something else is driving stocks than those classic fundamentals. In this case, we have an actual correlation coefficient of 43%. And then I think a lot of people, when they're wondering how to look at the stock market, they often say, maybe I need to know what's happening in the economy, and I have to have a decent forecast on the economy. And certainly the newspapers and the media always seem to go to, what's the economy doing today? And you bring out all these economists on forecasting the economy. And it's quite well known that economists are actually very poor at accurately forecasting what's going on, particularly dramatic shifts. They tend to forecast more of the same with some slight deviation. They very rarely capture the big dramatic changes. And I enjoyed getting this chart from the Bank Credit Analyst, which is a Montreal-based Canadian think tank that's well regarded and used globally. And they analyze, I believe it's about 16 or 17 major global markets over the space of, I believe it's 112 years. And they said, what's the correlation between, we now know accurately what the economy did. So if you were able to accurately forecast the economy, which very rarely people are able to do, how well can it forecast the market and the market behavior? And it's only correlated 17%. And so it's really not a very efficient tool to use for stock picking. And so that's why you hear people who are value managers, in particular Warren Buffett. He says, I don't really care what the economy is doing. And it's true. I like to say that value investing is for all seasons, because at any moment in time, there's industry groups or sectors that are struggling when others are doing extremely well. And then again, you've got individual companies uniquely shooting themselves in the foot and getting very inexpensive. So in any market, you can always find something new to look at or consider for purchase in portfolios. And this comes from a research study in 2002 by Peter L. Bernstein and Robert Arnault, and I think it was a very good long-term study in the early days of relatively long-term studies. And it looked at 200 years of stock market history in the US. And what it assumes, I'll help you read the chart a little bit, is it assumes that 200 years ago you were able to invest $100 in the US stock market. And if you never touched that investment portfolio and it accumulated value over time and you came across it 200 years later when they wrote this study and opened up this found investment portfolio, you would find that it was worth $700 million from a dollar. So a testament to a contiguously operating US stock market over 200 years, plus inflation and dividend yields and price appreciation. So a very handsome accumulation of wealth. And I often show it to investors, and unfortunately, despite advances in medical sciences, this doesn't represent anyone's investment time horizon, but it does represent a very lengthy period of time where everything that could happen at a market did happen. It was pre-taxation, then post-taxation, Civil War, 2 world wars, good government, bad government, inflation, deflation. Everything that could get thrown at a stock market pretty much has occurred. So it's a good representation of this has happened in the past, it might be what happens in the future. So then what they did was they did the math of repricing the market in real terms so that $100 back then was worth $100 today, so that you're looking at it in real terms. So they ripped the inflation factor in aggregate out of the data, and they found that in real terms, the $100 grew to $37 million. So still a nice handy sum that we'd all appreciate, some forgetful but thoughtful forefather leaving us. So then, what is this $2,100 figure? That represents if every time a dividend spun off that investment portfolio, that you spent it on current consumption. So this residual number represents the capital gain or stock appreciation of the overall US stock market with inflation ripped out over 200 years. And I don't know about you, but if your local financial advisor phoned you up and said, hi there, I got a great investment idea for you. It gets $100 to $2,000 in 200 years. Call me back right away. And you don't look enthusiastic. Are you rushing to the phone? And yet, if you went to the proverbial Joe Blow Canadian, remember the old TV show where they'd wander around Yonge Street and they'd stick microphones under people's chins and they'd say, you Mr. Representation of Canada, what do you think about this? So if you put that mic under their chin and said, gee, what do you think people invest in equities for? And I think most people would say, it's about capital gains, isn't it? And what this chart is proving to you is it's not about capital gains. It's about dividend yields. That the difference between 2,000 and 37 million is a dividend yield and the magic of compounding over a period of time for dividend yields. So investing is about investing with a focus on yield. Because for you to think that you're going to find that next new Microsoft and invest in it in its early days and get this huge pot of gold, that's very unlikely. It's very speculative and unlikely to occur. And that I actually think that what's rewarding for me as a fund manager and you as potential fund managers is that it's actually not rocket science. It's just being incredibly disciplined and focusing on the right things, and that, focusing on capital preservation and allowing the magic of compounding over long periods of time is a real wealth creator. But because of the behavioral psychology of finance, most people don't have the patience to go for just that, and they chase dreams and lose their principal along the way, and then they have to start all over again. Because keep in mind, every investment time horizon, most of us get about 40 years to start learning how to invest, make a few mistakes, correct our mistakes, then kind of get serious and do the right thing, and then you stop working, you gotta live off what you came up with as an individual investor. And so you don't know what moment in time, whether you're going to be in an inflationary environment or deflationary environment, and what lessons or practical tools you're going to use in investing. And that's often why investors need professional managers who look at financial market history and where we might be. This chart represents 140 years of US stock market financial history, and it's based on taking the market and breaking it into deciles based on the starting PE multiple. So when you go to the far left-hand side of the chart, group 1, 10% of the US stock market history, PE multiples were less than 6. And then you keep graduating up till the group 10, which was 10% of the time, you had a very expensive stock market with a PE multiple of 21 or greater. And the histograms on the chart show the opportunity set of returns that we saw over 140 years, the highs, the lows, and the average returns. And what you can see, just looking quickly at the chart, that the cheaper you buy stocks, the better your average 10-year returns, and the more you pay, the cheaper, the less return you ultimately get. And what I'm finding fascinating is a lot of people say, well, history has nothing to teach us because, boy, we got this whole different kind of market here, and we know all about financial market history, and we're way smarter than the old-fashioned guys that all of this history was based on. And we got our CFAs now and our MBAs, and we know this capital asset pricing model, and they didn't know that a long time ago. And they make all those silly old-fashioned mistakes, but we smart guys, we're not gonna make those mistakes. But I find what's really interesting is if you think back in 2000, what were people doing in 2000? They were willing to pay incredibly high PE multiples. The average PE multiple of the US and in Canada was 34. And most people afterwards, 10 years after 2000, the annual total return to investing in the US was roughly 1%. And if you look at the average number here, history told you it was going to be on average 1%. We got exactly the return that was being suggested. And this is really illustrating value investing. And that really, I believe, because of the behavioral psychology of finance, that people continually make the same mistakes and the market is not efficient overall. And I know I'm preaching to the converted. Overall here. And then just to underscore this one more time, I've collected some fun charts over the years, is this chart shows that you had the market peak at back in 1965-66, and then you went through this long sideways market to take the excess out, and then in the 80s and 90s you went through this phenomenal double-digit equity return. But if you'd put a chunk of money in at the peak of the 66 high, it's showing that your best annualized return, even at the peak of the market at 2000, was some 6 and change %, even though you'd just gone through virtually 2 decades of double-digit equity returns. And it was very hard to make up for that original mistake. Now, fortunately, most investors are dollar cost averaging into the market, and so they're buying when the market was cheaper as well, so that their end result is much better. And keep in mind what that 6.6, the 6 and change % return is. On average, through an entire equity cycle, the long-term history on the US market is about a 9.5% return. And so that's, you just can't get to it if you paid too much at the beginning. And then just to pause in Canada, just to talk about, we use a practical tool. We manage primarily in the Canadian market space, and we're best known in the large cap space. And the style box matrix that people are familiar with, you know, where you get large cap value, small cap value, growth, large cap, small cap, mid cap, et cetera, all those style boxes were developed in the United States, which is a deep, broad market. And Canada is much more concentrated, number one, and number two, we're one of the most resource exposed of the major markets in the world, which means we're fairly cyclical. And I'm not going to complain about the market being idiosyncratic, because actually all markets are idiosyncratic, but it means that it's very hard to play a deep value game. And for example, gold in the S&P 500 has never been more than 1% of that market overall. So if gold has a huge rally, like it did in 1993 and was up over 150% mid-year, if you don't own any gold as a deep value manager, who cares? It's like a stock. You know, you get one bad stock, but I can make up for that in an index. But if you're in Canada, and I think it's been 3 times in my career when gold's been more than 10% of the benchmark, and you're walking around going, I'm a deep value manager, I'm not going to own any gold. Well, in 1993, it hurt. And so I shifted over time and moved into relative value investing, which means that what I do is I try to be in all industry groups at all times, plus or minus a certain weighting, and then own the cheapest names within the sector. And that means I get a more consistent return relative to the market. I tend to get a lower standard deviation or risk ratio than the deep value managers do. And yet I seem to get the same long-term results of the deep value manager. But more importantly, meeting client expectations by not being too divergent from the market returns, because you know, a deep value manager, when cyclical stocks are flying, would be out of them, and when they're cheap would be seriously overweight. And from time to time could have such divergent returns, and clients don't mind if your returns are way better than they expected, but boy, do they really, it really bothers them when you're underperforming the benchmark. And if you do it for a couple of years, they start to really wonder whether you've lost your mojo. And so if you don't diverge nearly as much, it makes it easier to help them stand still and get the long-term returns. The Dalbar studies say most investors don't get because they bail on a fund because they lose confidence. The other thing I should say is, although we've managed a lot of risk-managed funds and they've been well appreciated by the market, now that we're in a long-term sideways market where returns are subpar, you are getting investors troubled by being with active managers because of the fee level. And when you have a low return environment, and I believe the return in Canada, I have a chart later on, since the beginning of the sideways market in 2000, the average annualized return to investing in Canada has been roughly 4.5%. And if you're in a mutual fund, most of them have a 2% fee. And so, you know, they're not getting much of a return and they're a little bit frustrated. So you're seeing people really moving into what's called benchmark agnostic funds, which are more concentrated and so fewer names in the portfolio, and they're really strongly stock picking, and they're able to get much better alpha. So we're moving into, we have developed some of those strategies as well to deal with what's happening in the marketplace. And interestingly enough, they don't have much more in the way of risk. And George also asked me to talk about, you know, how we pick stocks, to sort of give you this practical sense of how this value manager and their team picks stocks overall. And we start with a quantitative model. And we download information focusing in on stocks. And it's beautiful because early in my career, it was impossible to download information. Even to do pricing, we had to use a modem. And so my job was to get through the mail annual reports and pluck all the relevant numbers and put them into a model and calculate the intrinsic value. But today you can buy all these incredible cleansed data banks and just quickly and rapidly calculate valuations and intrinsic values overall. Our key model focuses in on on book value, historical ROE, and relative PE multiple, and normalized earnings to really identify what stocks are truly cheap in the marketplace. But it doesn't work well for all industry groups and all stocks. So sometimes we'll blend it a bit more by adding NAV, particularly to some resource stocks, or price to earnings is more relevant to some stocks. And so we'll blend it a little bit, but the lion's share of our investing is really on normalized valuations and where's the stock trading relative to the normalized valuation and intrinsic value overall. I just blended a couple of different charts in here. We start with that quant model, and then we move into fundamental analysis, because you really do have to marry fundamental with quant, because numbers alone will trick you. And if you will, data bank services, with a bit of scrubbing, are blindly plucking numbers off financial statements. And then you're taking those numbers and just throwing them into a quant model. And so we believe you have to get in and do deep fundamental analysis on the key numbers in your model to make sure they're accurately representing what's truly going on in the firm. So you have to stress test those numbers and making sure that there isn't aggressive accounting practices that's distorting the numbers. And if you do see that, then you could try and make adjustments of the numbers overall. And you're looking for other things when you're doing your fundamental analysis. We use a very structured questionnaire template. We have 18 major questions with a number of sub-questions. And it's a great training tool as well, because it actually is a fairly prescriptive questionnaire template. So when we hire new analysts fresh out of school, and that is our preference, to grow our own talent, some of the best fund managers in the world grow their own talent. You can't rely on somebody else to produce them for you. When we bring them in, the first week we say, here's a stock, here's our questionnaire template, go. And that questionnaire, they'll ask a lot of questions as they're going, but the questionnaire template really helps them write a really decent research report right from the get-go. And it starts off with what's the competitive advantage, then it goes into what's the quality of management. We have numbers of questions to help them determine what the quality of management is, what's the corporate governance, what's the financial risk, et cetera. And generally by the end, their results aren't that bad. And then we can read these PhD theses that we make them write and read between the lines and conclude whether their conclusions are good enough or whether we have to send them back to do a bit more research to get the picture clear on whether the stock becomes a candidate. And we break the market up into industry groups, and everyone takes responsibility for an industry group or a subsector, and so then they own their own performance. And then we can measure whether they're building a talent base or a skill level that adds value to the portfolio over time or not. And so we want to make sure over time that everyone is ultimately contributing to clients getting good, decent outperformance over time. And so, and this is a tough industry. You either cut it or you don't, ultimately. We try and work hard to make sure that we support people to become good decision makers, but not everybody is born to be a good decision maker. And so, we have to find that out over time. And just this kind of highlights some of the things we're looking at as well. I've hit on some of them already. But as a value manager, things like predictable earnings. If you have a forest product stock, then it goes from double-digit negative at the bottom of the cycle to double-digit positive at the top of the cycle, and the average is 8, how confident are you that that stock's going to hit an 8? Versus a company that's more stable and its ROE shifts between, let's say, 8 and 12 with an average of 10. You can have much more confidence that 10's the number you should be using. So your position size you would take in a stock with more predictable earnings would be bigger because you have a better chance of it hitting the number. So there's those little nuances in terms of how you pick stocks. You want conservative levels of debt because it keeps the risk of the fund overall. So if there is a calamity in the market, like 2008, your company is likely to survive without having to raise equity or have a big challenge. You know, we had tech have challenges in 2008, and it had to refinance at a very inopportune time, and it made them lose a lot of value because of having to do that at that moment in time. And we think that if you can see that a management team is a good capital allocator, they learn how to spend their cash really well. And often people don't get to develop that skill until they're a CEO. And so you want to see that this firm has a good culture of capital allocation, that they're probably taught who's getting groomed to be a CEO, or you want to watch that individual and see whether they have been good at capital allocation before you get a lot of confidence in the firm overall. And then, of course, you want cheap stocks. And then we're always looking for a margin of safety, a theoretical outperformance from intrinsic value of 30%. And we're always forecasting out in our model 2 years, which means that we're hoping to get at least a 15% return per annum from each stock. And why would you use this as a decision set? I mentioned a little bit earlier that the long-term nominal return to investing in Canada and most other markets around the world is roughly 9.5%. So 15 minus 9.5 is giving you a margin of safety of 5.5%, or if you will, a theoretical outperformance. And if you fall short and still get 2, you've won the game of investing for clients. And so that's embedded in how we pick stocks. So, you know, we don't try and buy stocks we think are only going to get a 10% gain. We really want a much fatter, juicier margin of safety when we enter a stock overall. And the bigger, the better in terms of ultimate returns for investors. And then it's important how you communicate as a team. And we meet in the mornings. We read different publications, we go to different meetings, and we share that collectively in our morning meetings about what's going on in the market and insights so that all our knowledge is accumulated together. Then we have weekly research meetings where we discuss these reports that we've produced, and then we collectively make a decision on, yes, we all agree that buying this stock at that particular price makes sense for our clients' portfolios, or which portfolio should it go into based on what the various attributes of the various portfolios are. And then we have every other month for every fund, we do an all-day portfolio construction meeting where we sit back and we try and look at the portfolio construction from multiple angles to make sure that the portfolio at all times reflects our best impression of the market at any moment in time. One of the biggest things that happens as a fund manager, and if you don't watch it, it can run away from you a little bit, is you sit there and you say, okay, this stock, based on its risk level and my confidence that it's going to get to the intrinsic value, I think it should be a 3% in the portfolio. And then if you don't look at it again, the overall market prices move around, and that stock price moves around, and so its relative weighting in the overall portfolio shifts. And so is it in the best position if you were to look at it today? Is it the right size position? Should you be trimming or adding to it? And so by trying to look at it with fresh eyes every other month, we find if you do it every month, you won't give it as fresh enough eyes. So we do every portfolio a big once over every other month. And is this accurately representing our best idea at that moment in time? And it's a really good discipline tool. And it can truly add value to portfolios over time, not to let things get away from you overall. And then it's how do you work together in a team? And so we have this kind of decision rule, and we make most of our decisions on consensus because we're all value managers rowing in the same direction, using the same philosophy and process. So we believe the same thing, but we're a diverse group, gender, ethnicity, educational backgrounds, areas of study in the past. socioeconomic family upbringing, and then we're all following different industry groups. And so when we're presenting on a stock in a sector, somebody else in the room is perhaps providing an input to that business, and somebody else is probably representing an industry group that's a customer of that business. And so they have a different angle of insight into the business you've written your research report on. And so we can ask questions and make sure that the analysis has been thoroughly vetted. And then we collectively make a decision about should we buy the stock and at what price would we start entering this stock. And we even forecast out what price we think we'll be selling it at. Now that can change over time as the fundamentals change, but when we enter it, we want to have a forecasted sell price. And, but sometimes you don't get consensus. And to us, consensus is that nobody's in opposition. And if nobody's in opposition, that's good enough for us. But if we have opposition, then we have a fallback to leader decides with input. And for each portfolio, there's a different leader. And the leader can pass that decision hammer off to somebody else in the team. Often it'll be the analyst who's covered the stock. They go, I don't feel so strongly about it. You're closest to the stock. You've done all the grunt research. We're going to go with your choice overall for this need. And you asked me to speak about risk management, and we do it at multiple levels. We're doing it at stock selection. You know, in particular at stock selection, we're looking at the levels of financial risk, and we aggressively avoid over-indebted firms, because really companies face three major forms of risk: cyclical, operational, and financial risk. The first two forms of risk, as a value manager, beautiful, love it. Send it in any old day of the week, because a really good quality management team with a great culture, they know how to deal with cyclical businesses. They've had it before. And management, you know, the operational ones risks are, you know, are you keeping up with the technological changes in your industry? Do you have good succession planning? You know, have you got a competitive advantage in the marketplace? Like that, again, a good management team can resolve issues that knock them off their game and get back on the saddle and get back to good results. It's financial risk that managements get to choose how much debt they will expose themselves to. And if you look at it out there in the world, if you don't have a lot of financial risk and you're in trouble, like these two get in trouble and that's high at the same time, you have a company that's at risk of going bankruptcy, and that's the biggest risk of all. So if you actively avoid financial risk, you take a big negative equation out of portfolios overall. So it's something we actively try to keep down to a minimum. And we like to buy stocks cheaply. And we look at portfolio construction. Another major way you can affect risk is by, you know, are you choosing to be broadly diversified, which brings down risk in a portfolio overall? In relative value, we're being broadly diversified across industry groups. In more benchmark agnostic, you can get concentrated, so you have the potential of adding risk if you bet a lot on a sector and it takes longer to come home to roost than you thought overall. And also by limiting the position size of every name in the portfolio, you can really limit overall portfolio risk and keep the standard deviation down. And you asked for some examples. So I'm trying to give you relatively recent examples. I can't give you any examples of things that I believe we're currently actively trading, so it's something relatively recent. Who knows, if the market price changes, we might pick up a bit more. I wanted to give you something fairly relevant, but also demonstrate the contrarian nature, because I know when you're a student, you can sit there and go, oh yeah, I'll be a contrarian manager. I'll go out there and buy the beaten up cheap stocks. I have the stamina and courage. I was out marketing today, and I'm going to show you our interest in oil stocks a little bit later. And I had clients there going, are you sure? Are you sure oil's not going to go down more? You know, isn't that risky? Are you sure you should be doing that? So you get tested a lot on taking contrarian bets in the marketplace, but that's really how you make good wealth. So, buying something like a Finning, which is the largest Caterpillar dealer in some fairly intensive mining regions, Alberta and Chile. And have you looked at what's been happening to mining resources lately? Prices have been down, and guess what? People aren't buying as much new equipment at the moment. And so it's created an opportunity to buy a good quality company at a great price. But you've got to do it when other people are not comfortable. And so it's giving you an illustration of a contrarian idea, and it'll take a while. Sometimes it comes faster than we expect. But we think there's an extra fun added kicker in a name like this right now, because you have a reasonably new management team. And we think that this new CEO has better capital allocation skills than the one previously. So we think you can get an extra bounce on this name when there is a turn in the cycle. And also people will throw out, we'll see a company like this and say, well, this is clearly very, very cyclical. It's living off the mining industry, which is a cyclical industry. But as a dealer, half your revenue is from new sales, and half your revenue is from repairs. And when you have a weaker cycle, people tend not to replace and get new, which means they have to do more repairs. And so they get half their income from repairs, and so it limits the downside in a name like this. So it's a defensive way to play a down resource cycle. And then another interesting name from, it's Morguard Corporation. And I've always liked Ray Sahi, who's the CEO of this firm. And he's another Warren Buffett wannabe if you haven't been exposed to him before. I first got introduced to him when I bought Ackland's, which was an auto parts supplier probably 20 years ago. And I always had a pet theory, and it seemed to work fairly well for me, is that there wasn't that many ethnically diverse CEOs in the Canadian marketplace. And so that if you were contrarian and believed in them, you could often make good money. And that's definitely been the case with Ray. He's a pretty sharp guy. And he's a bit like Warren. He likes to buy back his stock when it's cheap. So it's got a small float, so it won't tend to get picked up in index products. So it gets a little bit overlooked and underpriced. And so you can see it's trading below book when the overall market is like 1.8 price to book. So it's a pretty cheap stock overall. And it's overlooked and underfollowed. And that also leads it to be underpriced. But we think it's a really interesting business managed by a very astute leader. And then Teck Resources, a contrarian name here, because people are worried about material stocks. And the stock got cheap enough that we were able to purchase it. And again, it's trading at half a book, and it has a pretty attractive dividend yield. And the commodity prices aren't as bad as the stock price reflects, in our opinion, at the moment. And so this is a reasonably good entry point. We've kept our powder dry. If it got cheaper, we could buy more. If it doesn't, we should still make good money at these levels. And so just giving you a sense of some of the, touchier, less attractive, but, if you've got a patient investor, you can make money. And then you asked me to speak a little bit about looking at sectors. And so I thought I'd highlight sectors that today I think look very attractive. And this chart goes back to 1979. So it's a lot of history here. And it's showing the energy sector in Canada and the price to book value of it overall. And you can see that the level it's at now, and it got lower after year end, when oil got down to $43 a barrel, it would have had an impact on the sector. Whenever you've seen this sector down at these levels, you're pretty much at the lows. So you don't know when, you don't know how for value investing, but given the fullness of time as a patient investor, more than likely it's a reasonable bet that the price to book value for this sector will go higher, and you will make money for investors overall. And another point, value point is we believe that the marginal cost of supply for a commodity is the intrinsic value of a commodity. And the economic equilibrium for the commodity price is to migrate towards that intrinsic value or marginal cost of supply. And a marginal cost of supply, it's a debatable number, but you get enough professionals in the industry, they coalesce around numbers. And what would it cost to get the next new marginal unit of that commodity brought to the marketplace? And most people believe today the marginal cost of supply for energy is about $85 to $90 a barrel. And the commodity price today is trading around $50 a barrel. And you look in history, it goes back to 1990, the green line is the marginal cost of supply. And you can see the commodity price bounces around a lot, but it has an elastic band that seems to keep pulling it back to that marginal cost of supply. So you get it moving well above from time to time and well below. And then the line at the bottom, a little dotted blue line, is the estimated cash costs. So it's like, forget the sunk costs. This is like cash costs, which you still produce if you can get cash costs. And you can see that from time to time in this history, the commodity price has fallen down to the cash cost, but it hasn't stayed there very long because it's very challenging for players in the industry. And then it tends to, not that long afterwards, tend to move back towards intrinsic value because you get this supply-demand response that puts things back into perspective. And so we had to go down to cash costs at year end. And so we've had to bounce a little bit off that bottom. And we sort of stabilized a bit at $50 for a little while here. There's no guarantees, obviously. But if you've got I believe, a 2 to 5 year time horizon, it's fairly likely you're going to make a decent return in an energy exposure in your portfolio overall. And so that we think this is that rarer opportunity to go and position yourself in these kinds of names in that sector. So now I'm going to talk about one of my pet passions, which is the sideways market theory, and looking at financial market history. And the TSX only has comparable data going back to 1956. And so that doesn't give me enough time to see how irrational human beings interacted with financial market data in the past. And because the US is our largest trading partner, and we're one of, between us and Mexico, we are their largest trading partner, we're fairly connected at the hip. And our markets tend to move in tandem, but not always in the same quantum. And so we're going to use the US as a proxy for Canada. There was a stock market part of 56, but it wasn't composed in a similar fashion, so we can't compare to it. And here we've got data going back to 1873. And what it's highlighting is that markets operate in two speeds. You get bull market phases where markets have double-digit equity returns, and then they sort of get overvalued, and then they realize they've overdone it, and they go sideways in an incredibly volatile fashion. Sideways markets are much more volatile than bull markets, which generally just tend to go upwards. And on average, you get sideways markets lasting a minimum of 15 years, in one instance as long as 30 years to take the excess out of the market. And the hallmark of equity markets ending sideways markets is that the PE multiple of the overall market, you've gone sideways long enough that you've taken all the excess out of the market, you've burned the speculators and the market timers, and they've walked away from the market in disgust, say, I don't understand this anymore, I don't want to play, so the market can get cheap enough overall. And then you set yourself up for another magnificent, lovely bull market run. And let me dive into this a little bit more to prove my theory. And I'm positing North America entered a sideways market in 2000. And so we're in year 15 of a sideways market. They've never been shorter than 15 historically. And so where are we going to end this sideways market? And currently both Canada and the US are sitting around PE multiples of 17. So they're not at single digits. And often you have interest rates change direction. So everybody's sitting around going, when are rates going to, they've been falling for 34 years, when are they going to start rising? And I'll talk a little bit about that later, but then you generally get it changing around the same time. So in this chart, from 65 to 82 was the last sideways market that we can examine. And what you have on this chart is the blue line is the S&P 500. And so in the first portion of this chart, you're in a bull phase. You're having the market go up, but the story underneath the surface is the soft gray line, which is the PE multiple. And people are getting so enthusiastic about the game of investing in a bull market, they're willing to pay more per dollar of earnings to enter that game of investing. So you get what's called PE multiple expansion. And then when you enter a sideways market, you see that soft gray line starts going down in a stepwise fashion. So the market itself goes sideways, the market stalls out, very volatile, goes sideways, and meanwhile, because the market's going sideways, you're leaving the problem of solving a high PE multiple to earnings growth, because P's staying sideways, so it means that E has to grow to get the market to cheap. And because earnings growth in aggregate is just under 3% nominal, it takes a long time to solve that problem on average. And so it goes down in a stepwise fashion because you're having all these mini economic cycles, and the PE multiple slowly drifts down to single digits, and then it generally hits the bottom. You see it hitting below single digit PE multiple. So here's the 10 PE multiple over here, so you eyeball it over. You see it hits base in 1975, and then most cases it goes one more economic cycle, it hits it again, and then you could start a new bull market run. And then I'll highlight again then you had a bull phase in the 80s and the 90s, and then you hit a sideways phase in 2000. The Canadian angle under this chart is the red line. I believe there's a trade-off between two major investment categories, financial assets represented by the stock market, and fixed or hard assets represented by art, collectibles, and commodities, and real estate. And when one's in a bull, the other has to be in a bear, because by definition, to be in a bull, you grow faster than the underlying fundamentals. And so you have to take cash or resources from somewhere else. And so they take it from each other from time to time. So when equity markets are in a bull, commodities, the red line's coming down or sideways. And then when financial markets are going sideways, commodities are rallying. And they tended to be polar opposites overall. And Canada tends to outperform most other major markets when we're inside a sideways market. And Canada has been outperforming a lot of major markets so far, this sideways market. I said Canada had since the sideways market began, we've had about a 4.5% return in Canadian dollar terms. The US has had a 3.5% return in US dollar terms. And if you convert it in Canadian dollar terms, if you convert it into US dollars, again, Canada's outperformed the US by over 1%. I think I have that chart. And this is showing you the Canadian sideways market so far. And we peaked out at 11,388, and we've crossed through it several times. And what I'm highlighting is in September 2000, when the index was 11,388, the PE multiple in Canada and the US was an unprecedented, never seen before in financial market history, close to 35 PE multiple. And then price to book, record high, never seen before, 3.2 price to book value. And then you had a pretty rich price to sales ratio and a record low dividend yield, never seen before. So just really an extreme market. And then you enter the sideways market and you keep crossing through 11,388 several times. And what we're highlighting them here, and you see the PE multiple was dropping and got down to historical averages. The price to book dropped, got to half, close to the historical average. Dividend yield tripled and got to the historical average. And then we've recently gotten expensive, above historical averages. And I believe history says you usually get cheap before the sideways market is fully over, overall. And a number of people have tried to say that we're already in a bull phase. And we'll see. And this comes from the book Active Value Investing by my friend Vitaly Katznelson in Colorado. And he wrote a fantastic book about the sideways market and did all the heavy lifting data. And what he's done is he's showing you here that there's only 3 sources of equity returns. I'm helping you up there by showing you earnings growth plus the change in PE multiple plus the dividend yield gives you the total return to investing. And he uses slightly different terms. He calls it earnings growth. And so you can see in a range-bound markets, earnings growth is 5.6%. And in bull markets, earnings growth is 5.6%. And he's showing you at the bottom all the range-bound markets and all the bull markets he's used. And isn't it fascinating that between a bull market and a sideways market, the earnings growth historically was the same? So that doesn't explain the difference in returns between the 2 markets. And then he goes, what he calls plus or minus PE growth is whether you're getting PE multiple expansion or contraction. And in a bull market, you get expansion of the PE multiples. In sideways markets, you get contraction of the PE multiples. And what he's showing here is in a range-bound market, PE multiples collapse and affects returns about just under 5% per annum on average. And in bull markets, they expand and help out total returns to the tune of 7% per annum. And then he says for the stock return, which he calls the capital gain, which I would call the capital gain in more easy to understand terms. So on average in a sideways market, your capital gain from investing is 0.7% per annum. And in a bull market, it's 13. And then you get your dividend yield for your total return of 5.9. And point out in the sideways market that the dividend yield is 90% of your total return. So in sideways markets, dividend yields matter a lot. And in bull markets, nobody cares about dividend yields because it's all about capital gains. So they don't even pay dividend yields of any note. That's why in 2000, dividend yields plus because of the price movement, 0.8%. The total return is 17%. So what it's telling you is learn to love 6% because that is the rational expected return on average inside sideways markets. So set your expectations lower. And the returns so far this sideways market have been lower than that overall. And there's the return for both Canada and the US that I promised. And I know people are looking at the US over the last couple of years and went, wow, that was a fantastic return. Poor Canadian investors. But in actual fact, throughout this sideways market, we have done better overall. Now this is a messy chart. You're not supposed to show people messy charts like this. It comes from the Ned Davis Group, which is we subscribe to this service. And I want to use it because it's such a fantastic chart and it tells so many stories. So the top third is showing you the equity sideways market. So when you see green, it's the bull, and white's the sideways. And then you go to the bottom third of the chart, and it starts in 1900. And you go to the bottom third of the chart, and it shows you the commodities. And if you go over here, when you see white, it's green on the bottom, and then when it's green, it's white. So it's the polar opposite, as I told you earlier. In the middle is the bond prices. So the most recent experience over here is you're seeing bond prices go up, which means bond yields have fallen. And so you're giving you where it's happened in the market. And it adds a new element to looking at sideways markets because whenever you see the bond yield change direction, but when bond yields change direction, historically equities have always entered a bull phase. If you can just look at that chart, you can see that. So it doesn't matter whether it's inflation or deflation because a full equity cycle is a sideways market and a bull market. And so when it changes within a reasonable period of time, equities go into their full bull phase and commodities go into their sideways phase. And so the big question mark for all of us is, when are rates hitting bottom? And a lot of people thought that rates hit bottom in 2012 and that it started a new bull market phase. And but it was a bit of a head scratcher because PE multiples weren't low. And we now have all of Europe hitting this summer, 2, 3, 4, 500-year lows. And Canada last month hit an all-time record low. And if the last time we were in a similar period was in 1941. And the period leading up to it was a deflationary period. We'd gone through a major financial crisis in the 30s. And then interestingly enough, the commodity cycle lasted longer. Because you had an all-new record low interest rate in both Canada and the US. And back then, the all-new low record interest rate was 1.95%. And in 2012, the US hit an all-time record low at I think it was 1.45. Canada recently was down to 1.24 in the last month. It's now back up to 1.42. But you can see that the commodity cycle unusually extended and went longer. And because in 1941, you're in the middle of a war, and you needed commodities to fight a war, and then when the war was over, you needed commodities to rebuild. And so the commodity cycle lasted longer. But people also wonder whether the commodity cycle lasted longer, because now you're in an inflationary period, and inflationary periods mean commodity prices are likely to rise. And so it's the only other instance of going from a deflation to an inflation on this chart. And even the Ned Davis group said for commodities, gee guys, we might have that here. We might have the commodity cycle extend longer because of China and India coming from emerging to developed. And so keep that in mind that that's a possibility. And we will go from deflation to inflation. Would that keep commodity prices going for a little longer overall? And so what the sideways market theory is telling us here is we're probably not at the sideways market yet, that interest rates haven't hit their bottoms, they're likely to still test bottoms, and that the commodity cycle may not be over yet. We'll all hold judgment. It's kind of fun. We're not really driving our value portfolios on this, but it's an interesting observation overall. And the Hoisington Group, which is a very deflationist-focused bond fund, it's done extremely well, put this chart together. They said after a major, and it ties in with the Reinhardt and Rogoff studies, after a major financial crisis of major developed economies, let's choose some instances, and they came up with the US in 1873, the US in 1929, Japan in the 1990s and on. They said, how many years after a major financial crisis did it take for interest rates to hit an all-new record low? And the answer was a little over 14 years. And then they put the current experience up, and it's been 7 years since the 2008 financial crisis. And we don't know how long it's going to take for rates to maybe find all new record lows. But, it may be a bit longer, it may take longer. And so to just keep that thought in mind overall when you're investing and be careful of making significant bets. Sharing my 500-year-old investment advice from a guy named Jacob Fugere the Rich. He was one of the richest men in his lifetime. And back then, wealth was highly connected with being nobility. And he was not nobility. He lent to nobility largely to fight their wars and other things. And this has been translated from the High German by Karl Otto, who I used to work with out of Montreal, and he was from Germanic descent. And he says, the quote is, divide your fortune into 4 equal parts, stocks, bonds, real estate, and gold coins. And I will modernize that statement for saying back then gold coins was the currency of the day. And so it really meant T-bills in his mind. So just keep that interpretation. And I would say the more modern interpretations, we have much more financial choices available to us today. So he's basically saying figure out an ideal asset mix and stick with whatever that asset mix is and rebalance. And then he says, be prepared to lose on one of them most of the time. And I think that showed how brilliant of an investor he was, because he said, I don't believe in market timing, clearly, if he's making a statement like that. He's saying something's always going to be in trouble. Accept it. This is why you diversify. And then he goes on to talk about the laws of financial gravity. And I found it fascinating when I came across this quote because he understood the laws of financial gravity 500 years ago, and they didn't change. And he talks about how, in deflation, bonds win, and in inflation, commodities win, and stocks see you through both periods, but in a bit of a mixed fashion. Then he comes back to advice, and he says, whenever performance differences cause a major imbalance between the four equal parts, rebalance back to the four equal parts. So what he's telling you to do is to sell your asset mix winners and buy your asset mix losers. So from an implementation perspective, that's easy to do. But from a psychological perspective for human beings, not easy to do at all. Sell what's been making you money and buy that which has been causing you pain. But what's old is new again. In the last 15 years, you've had all these studies done for the benefit of the big pension plans on dynamic rebalancing. And that the more frequently you rebalance back to your ideal asset mix, and for pension funds, their ideal asset mix is based on, what is the longevity of their employee base, and so they all have different asset liability matching. So we don't care what your ideal asset mix is, but what we can prove is the more rapidly you rebalance back, the better your long-term returns. So a good piece of advice for investors, and one of the better ways to do asset mix, I think. And then I definitely wanted to address the issue of women. And I've been in the industry 30 years now. I started working in the investment business in '83, so not long after we entered the bull phase. And women in the CFA Institute were, about 17%. And today we're about 17%. Gee, I really thought things were changing in my career. And it didn't really change. And it used to be that, asset management wasn't a great career. Like, women are good at asset management, but there wasn't many women in asset management. But I could always say, well, there's less women in investment banking, so we're not as bad as them. But that's changed, sadly. And now you're showing that asset management is one of the worst industries for hiring women and promoting women and keeping women in the industry than other fields. And I think that it's very conducive to women having families because it doesn't require that you have face time in the office every single night. Unlike law, unlike investment banking. And we know there's lots of studies that women make better fund managers, better hedge fund managers than men because we don't invest with an ego. So where are the women? And I thought I'd have more women, where are the women in the classroom today even? I'm glad to see that there are some because earlier in my career, I got invited to universities and there'd be one or two. So there is a change, but not a significant enough change to really move the dial. So I want to talk to the men in the room because you get the chance to change. The studies show women are better at this than men. And you're going to get promoted if you hire the best team members. And some of the best people, nobody else is looking at them. Nobody's giving them the leg up. So do it. You can change the dial. You'll benefit your career, and you'll change the game. And you'll have more diversity in your investment team, which means you're not going to make as many mistakes because you're going to have more smart minds sitting at the table. And so I just really wanted to plant that thought to the men in the room when you end up working in the investment business to give, the women the promotion. I've definitely seen women overlooked because men will say, I know what this guy's failings are, but because I know he's a guy, I know him, and I know I can make up for what he's lacking. But then there's this woman, I don't know her nearly as well, and I don't know how I can make up for what she's lacking. So don't give her that shot. And I think it's a shame for our industry. And I think it's reprehensible, and we collectively have to do something about it. And I wanted to stand up for that today. And then we'll put this up here on discovering your intrinsic value and the 3 stages of a career. And the first one is being technically competent. And the second stage is trying to be an expert in your field, and the third is to be world class. And you just keep upping your game as you go through the various levels. And I think it's very important, especially as a fund manager, to save money and save dollars and start doing it early, because then you understand your clients, because you've saved too. So you understand what they had to do to get that little pot of gold that they're handing you to manage. But it also frees you up, because you are in a risky game. And the more you're financially comfortable, the more you're going to do the right thing for clients, because you know you don't have to worry about yourself. And it also allows you to let luck happen. And you can take advantage of opportunities out there. You could take another job that may not pay as much, but will further your career because you have savings, for example. So why don't I stop here and handle questions from the audience on any topic you're interested in, or challenge me on some of the things I've said. While I'm waiting for the question, I should add that I've been doing my level best to change the dial on women. And the 3 most senior portfolio managers at Sionna are all women. And our new associate portfolio manager, Marlena Zablowski, came from this classroom here. And so we're about to have 4 out of 8 are women in our team.
First of all, thanks a lot for coming here. That was really good. Really good presentation. I really enjoyed it. I was just wondering if you'd talk more about your evaluation of management. What kind of metrics you use? How do you go about evaluating management?
Are they a vivid spirit? Do they inspire other people? I mentioned earlier, have they demonstrated skills as good capital allocators? Do they pay themselves fairly or egregiously? And we have found that CEOs who pay themselves egregiously have a high correlation with aggressive accounting practices, which means that your numbers will get tricked and you'll think the company's doing better than it really is. And so we actively avoid that. And that the book Good to Great, I think, did a great job of highlighting that that larger-than-life CEOs build vulnerable firms, because they build the firm around their personality and the cult of their personality, and they can't be replaced. And then when they retire, the firm struggles for a period of time to find a new normal. And that you're much better off having a lower key, quality CEO who really runs a really good team. And that when you pull that CEO out, the culture and the capability of the firm continues. And you really see that in certain companies. Like I would say the Royal Bank and Bank of Montreal are really strong corporate cultures. And as they shift from CEO to CEO and Scotiabank, you really do not see the culture changing dramatically. Whereas a firm, historically anyways, at firms like CIBC and somewhat at TD, that you've had very different personalities and you'll have a whole different style going on and a little bit of vulnerability as it makes that shift in the other banks. Just giving an illustration that people might appreciate.
Thank you for your the advocacy on women in the industry. I also think it's a very important topic. So I have several questions. First of all, you touched on for your investment decision, you look for returns of 15% annually and 30% over the course of 2 years. Is that generally your holding period in terms of your investments, or you look at a longer duration?
Why we focus on the 2 years is because we don't think we can, there's lots of people who specialize in doing earnings forecasts. They try and get a really accurate earnings forecast. And we think that's really hard to do well. And so in our model, we tend to use consensus earnings estimates. Now we're aware consensus earnings estimates are always a little too positive, so we can cram them down a little bit. But you can't get forecasts out longer time horizons. So that's why we use the 2-year time horizon. But given that our turnover ratio is often 20% or less, that infers that our hold period on average is 5 or more years. And so we're constantly relooking at what the intrinsic value is as time goes by on names. And ideally, you get what was once called 10 baggers by Peter Lynch, where you first buy a stock and you think it's going to get a 30% expected return, but 2 years from now, the expected intrinsic value has gone up virtuously. So of course you're not selling it. And then it goes up again and again. And so that you keep holding it for a very long time period and you keep not selling it because its intrinsic value is rising more rapidly than the stock price. And those are the big wins. But I saw a great presentation once that they did a presentation on what they called all-star stocks. And an all-star stock is a stock that over a period of time manages to give you an annualized return of 20% or better. And those are incredibly rare, actually. And so when you do get that, then you really know you're onto something, a really amazing name. But there's not many that occurs to, or it does happen for a period of time. And the game of investing is the average return is 9.5. So I'm gonna really simplify. I like to keep things really simple because I actually think humans can't handle a lot of complexity. The game of being a portfolio manager in its most simple terms is the bogey's 9.5% annualized. So I'm aiming for 15 or more. That's the minimum I'm looking for. So all I want to do is stuff into my portfolio as many names that are going to get me 50, better than 9.5. And then I actively want to avoid anything that's ever going to get me less than 9.5. And then I should win the game of investing more often than not. So if you can just get it down that simple, it's more likely you're going to win. Now, occasionally, you're going to have the overall market going up 30% in a year. Well, that's a little bit hard to win at. But on average, it's 9.5. And certainly when it's below then, you're going to have a slam dunk win. I find we can generally keep up with up to 20% expected returns. And then as it gets closer to 30, as a value manager, it's really hard to keep up. But that's usually at the end of a cycle.
My other question is on diversification. I know some of the value investors prefer not to diversify, but rather invest a lot in a few companies. What's your take on that?
Well, we're also investing in benchmark agnostic. And it's really what is a client willing to tolerate? By being broadly diversified, you can bring the overall risk and the beta of the portfolio down and more stability for the client. Benchmark agnostic can get great alpha, but it can also have periods of underperformance, which can be very challenging for investors to stomach. And there's lots of studies about, investors tend to bail after a fund's lost money, and then they go to the next winning fund that's about to lose money, and it's a recipe for not creating wealth ultimately. So it's a great way to invest, but if you're going to enter an investment style like that, you either have to have a lot of support of somebody who helps you stand still and stay in the investment, or you have to have, I call it an iron stomach, that you say, no, I believe this manager, I know what they're doing, I absolutely believe they're going to win in the long run. I've looked at their historical performance track record. I'm going to stick with them throughout the period, as long as the key people are still in place using the same approach and the same model and they haven't drifted. And you do a lot of analytics. There's a lot of people hired to go do those things for clients.
So I just had a question coming back to the benchmark agnostic. So I was wondering, during periods of, I guess, intense bull markets, there might be times, especially in a small market like Canada, where you might not be able to find investments that are particularly attractive in any given industry. So I was wondering how you deal with that tension between actually looking for value plays within an industry to maintaining that benchmark agnostic.
Yeah. Actually, I see that much more running a relative value portfolio. When the overall market gets pricey, then all stocks are pricey. And then you can't find much of anything that's relative value. Like you look how far and wide and you can't find anything that's decent quality that's trading below book or at a cheap PE multiple. And we can't find expected returns of 30% or greater. And the ones that we do are just bad quality with a lot of attributes we don't want to own. But we want to stay invested in the market and get the best possible return for investors. Then we'll shift down from a 30% expected return down to, let's say, a 20 and see if we can widen our opportunity set and then try and buy the best names. The other thing that we'll do is we do what we call more switching, because you're running this portfolio. And running a portfolio is a bit like running a wine cellar. Like you go out and you buy wines, and they all mature at different times. And if you're watching your wine cellar, you don't want to have vinegar in there. It's not very good for value, right? And the vinegar is the value stock that rolls over. So you're trying to watch what's mature and has to come out of the cellar and be consumed. And from a value investor, it's fully valued. You've got to take your profits. And when the overall market gets expensive, you're wanting to take all the bottles out of the cellar, and yet you want to have a future to drink that tastes good. And so you can't take everything out. So you got to replace some stuff. You got to go find some new names. And then you have that balance between, I'm so worried this stock's so rich, it's going to roll. I have to get out of it. And yet I can't find a replacement to put in. So that's when we do what I call switches, where I can't find a 30% expected return stock in the same segment or sector, but I can find a 20% expected return, and it has a cheaper PE multiple than the name I'm selling, and it has a better dividend than the name I'm selling. So I get better characteristics, and I like the company, but I don't have 30% expected return. Then I'll take my risky name out of the portfolio, and this name, although it's not ideally what I'd like, I get a bigger future. And I can stay and get a decent return anyways in a market and then wait for better opportunities. And hopefully I've got a cheap name. And generally speaking, when you have an overall market have a schism, like you have a 9/11, you open up the market the next day is down 20 to 30%, or like October 1987, you have a whole market have a big dramatic collapse. What you find is you get a different stocks collapse than others. The ones that collapse the most tend to be the high flyers with the big fat valuations. They really crash down. The high dividend yielders, the low multiple stocks, they say they're in strong hands. They're in the value manager's hands. We all have iron stomachs, We're not going to sell our names. We know they're good. It's the nervous growth guys who are going, oh my goodness, the market's crashing. They're tossing their stocks out at bargain prices. And it can create fantastic opportunities for value managers. So in those environments, you say, well, I'm fully invested, but now this stock that I can never buy is suddenly cheap enough and looks decent for me, and I can take my name that just fell a little bit and take profits in it, because I probably still made some money, but buy the name that when the market recovers will bounce a bit more. And so you can play with the fact that you don't have absolute values overall within a whole portfolio construction. But you're trying to get attributes that will benefit clients going forward in the future. And also stabilizers that allow that opportunity to say, in a collapse, I know this stock will go down less, and I can trade out of it. For us, one of I shouldn't always give away all our secrets. One of our favorite so-called counter-cyclical stocks is food retailers, for example. And when the market goes up dramatically, they lag. and they become not that exciting, and or even get abandoned so people can go chase the stocks that are going up. Or when the market's weak and declining, people want to hide in the safe haven of food retailers. And so they move counter-cyclically. So for example, in 2008, our best performing stock was Empire Foods. The overall market was down 36%. Empire was up 15%, or just under. 2009, how do you think Empire did? It was one of the worst performing stocks in our portfolio because everybody was chasing junk. And so we'd already, when we sort of opened up our portfolio a little bit after 2008 in our all-day portfolio construction meeting, this name that was sort of a middling-sized holding in our portfolio was suddenly the biggest relative bet in our whole fund. The biggest overweight relative to its weight in the index. And we said, well, what we do is we rely a lot on behavioral psychology inside the team. So we looked at the analysts responsible for food retailers, and we said, is Empire our very, very, very best idea for clients going forward in the future? And the body language says it all. Like the dodge, the look away. Like, yeah, it's a great stock, but no, it can't be the very best idea for clients going forward in the future. So, all right, that's going to be a trim. We're trimming. So we took it down. And so it wasn't a big position when it sunk the next year. So that's another way of handling those kinds of issues.
Can you just quickly comment about the position limits and value traps? How do you identify them?
In our relative value portfolios, we're benchmark aware. So we want to know what the weight is in the benchmark. If you like a stock and it's Royal Bank, and I think at one point Royal Bank was 6% of the index. If you have a 3% position, it means you're betting against it. So if you think Royal Bank's going to outperform the market and it's a 6% weight in the benchmark, you better own more than 6%. So it's going to affect the weighting. Then it's our perception of risk. So our average position size is around 3%. If we think the stock is really risky from our perspective, but a great opportunity, we'll buy a 1% position. We'll buy a modest position. If it's low risk and we have a very good idea it's going to make a return, and we think it's low risk, we'll take a much bigger position, maybe a 4 or 5% position, even if it was like only a 2% position in the benchmark. So that's kind of the position size. Our benchmark agnostic funds, we try and be relatively equal weight of all the names. We don't spend a lot of time on that. So we just say these are our best ideas. Our position size should be 3 to 7%. And let's just get in there. So we're getting bigger bets going on in those funds. So we're not going to have a 1% weighting in those portfolios at all. So value traps. Avoidance of financial risk is a really good one, in our opinion. We try and avoid management teams we don't trust or believe in. I actually learned value investing from John D. Tommaso, and I will say very respectfully, he was a deep value manager, and I would call him a cigar butt value manager. They could be yucky, stinky, awful companies, but some deep value managers will talk about dead cat bounces. We don't tend to, everybody has a different flavor. We're not fond of that particular flavor of investing. I think that helps you avoid value traps to some degree. Because I like to say I want to have a stock so when everything gets into trouble, I have a leg to stand on for why I owned it. And if I didn't like the management or I didn't like the business, it's hard for me to sort of justify why I bought it in the first place. Well, I thought it was going to have a dead cat bounce. That one doesn't really work for me. The biggest challenge, I think, as a value trap is fraud. And as much as we've developed some techniques to try and see frauds in advance, I'm not sure we can always do that. Because businesses are motivated. There's a segment of business managers at all times that are motivated to cut the cake short. And they're going to look for cracks between the lines of legality to do it. And they're going to be really innovative, and they're going to find novel new ways to play tricky games. And it's pretty hard to know them all. And we've developed some ability, but I'm not convinced we'll know the latest or greatest all the time. But by sticking with managements that we feel comfortable with and that we feel have integrity, and certainly if we see that there's a minimum of aggressive accounting going on, that gives us some comfort. Because often the frauds have had levels of aggressive accounting embedded in them. And there are some tips that you can rely on, but I've been hosed a few times on it myself. And I'm not sure I can learn and avoid them all.
In value investing, traditional value investing, we learn to avoid cyclical industries. However, I guess in the Canadian market, as you mentioned, this is a very idiosyncratic market, very concentrated and very resource-driven. So I guess it makes sense to do relative value investing just to perform better than the benchmarks. If your mandate was more of an international mandate rather than a Canadian mandate, how will your strategy change, and will you go for a more traditional value investing strategy?
Well, it would be certainly easier in certain markets like the US, where you can play deep value, and you have such a deep, broad, fat market, you can find enough choice to stay within that game and play it. But our primary client base is managing Canadian equities. So absolutely, you could do that. But I also believe there's a room for relative value investing globally too. And it has a different attribute and characteristic that some clients would find valuable based on what they're attempting to do in terms of risk management and consistency of returns.
What is the most important thing you learned in life and investing over the last 30 years?
The most important thing I learned in life in investing in the last 20 years. George, you should always give that question in advance. So I have time to ponder a 20 or 30-year career, because there's been so many lessons. I think you learn from all your mistakes, and you will have mistakes. I think one of the keys to surviving in investment management is learning to live with your mistakes, because there's no hiding from them. And you just have to learn to accept that if you get more things right than wrong, you can and will win the game of investing, and not to focus or angst over or spend too much time focusing on what didn't work, because we all have things in our portfolio that don't work as planned. But for me, as a team, I think it's about being collegial and working together at all times and supporting each other through the rough times. And there will be rough times when we're learning our mistakes. And that's key.